Welcome back to another week of Modern Money with Mike and TJ. Mike, how are we doing today?
Doing great, TJ. How are you?
Doing well. Can't complain. I thought we would jump into some discussions about bear markets today, given that we have officially kind of entered that bear market territory. So I'd love to hear some thoughts about, how you're handling it, strategies for dealing with bear markets, what you're talking to clients about, and just kind of get your general thoughts and takeaways.
Absolutely. No, it's definitely worthwhile discussing. It's May, and I'd have to look at the data on this, but it seems like it's sort of snuck up on us, and maybe we've been fooled in the past. It seems like some of the more recent bear markets have been a little more almost very quick. I think obviously COVID is one of them where it was almost overnight or over a couple of weeks, but really since January it's been a relatively steady-ish directionally decline, and then here we are, May 12th 2022, 4 months later. It's like, okay, well, it's we're there. We've surpassed the 20% mark, which is what they use to define a bear market, and
Right.
Here we are. What are your general thoughts?
Yeah, I mean, it's interesting because, how fast markets are moving nowadays. And, I like to look at historical, perspective there as far as like what have bear markets looked like in the past. And just kind of, I think it's important to understand and maintain that perspective to really think about how bad things are. March 2020 was definitely a scary time with the pandemic. And I think that was the fastest drop for peak to trough, it was like a 33% drop, but for that span of time, it was the fastest. And so, yeah, like you said, this year we're now down 20%. If you're looking at like a broad-based market index, like a VTI, which covers like the total US stock market, just hitting that 20% decline. And it's pretty quick because, like you said, it's over the span of 5 months. So it could definitely be scary for a lot of people who are, especially if you're dependent on your investment assets. And I think the thing that's a little bit scary about this bear market is that the bond market is also down, substantially. I think the last time I checked, the aggregate bond index is down like 10%. So if you are more of a retirement type investor and you maybe have that traditional style of like a 60-40, 60% stock, 40% bond portfolio, usually you think like, oh, your bonds are going to hold up as that shock absorber. But unfortunately, that just hasn't been the case with like the interest rate environment and how quickly interest rates are moving. So it's a really interesting environment. And yeah, I'd love to hear your thoughts on just kind of like how you're working through it with clients, whether that's the clients that are in that accumulation phase versus maybe somebody who is dependent on their investment assets. Love to hear your thoughts on that.
Yep, absolutely. And I agree where you started is just looking at history, right? And this is I think whenever markets decline, no matter who you are, for the most part, there is pain involved, right? There's some pain. No one likes seeing red in their accounts. And so it helps to frame it, right? It helps for perspective, just like anything, right? Skinning your knee is going to happen as a kid, but and it, but you still don't like it. Roller coasters are still scary, even though or whatever, they get your heart rate up, right?
Yeah.
What's coming, what's going to happen, and then still doesn't feel good. And so sometimes, I like to at least tell clients that hey, my accounts are down too, right? And I don't like it. I don't like it either, right? But I think with clients, it's there's definitely different types of financial situations, right? In generally, our clientele, right, for you and I both, skews younger. So generally, folks are more in the accumulator phase, is what the industry likes to call it, right? And it sounds silly, and I definitely don't shout this from the rooftops, but right, just doing the math, when you are accumulating, you are adding, you're saving, you're adding to your 401k, right? In reality, a good thing that could happen to your portfolio over the next is say for the next 10 years, the market is awful. It's terrible, right? And you're just buying and saving for the next 10 years at super low prices. And then it goes up, right? If you put $100 in the stock market, it feels good when it doubles, right? It really feels good when it doubles. But if you have over the next 20 years, another $1 million you're going to add, then in reality, you want to be buying that at lower prices, right? Again, and right, we understand this with almost every other asset except for stocks, right? Even real estate, right? If you're going to be buying a real estate purchase, you want things to be lower, right? You're buying shirts, you're buying gasoline at the store, you want it to be lower, right? And so for accumulators with stocks, again, math wise, it's similar. And so it's, slamming ourselves with historical charts, perspectives, and different perspectives like that. In my opinion, it's helpful to get through it, but again, it's still painful, right? It's just, anything you can do to shift your perspective a little bit.
Yeah, for sure. And I think this is hard too, because, a lot of people don't have like a frame of reference for these drawdowns. Cause there's really large drawdowns in certain areas of the market, like in the more technology or growth oriented companies. There's companies that are down 50, 60, 70%. Cryptocurrency is in like a massive decline as well, 60, 70% drawdowns. So depending on what you're actually owning, you could be feeling the pain a lot more. A 20% drawdown in the stock market definitely doesn't feel good when a large portion of your net worth is in there. But if you are somebody who has a lot of even more, very speculative type investments, you're probably feeling this pain a lot more. And so, that is why it's so important that when things are good during bull markets, that you understand your long-term strategy there, because it's not just about getting those returns in any given year. You're going to have these periods of bear market declines. And number one, can you stomach the drawdowns? And what are those drawdowns going to do to the compounding effect of your growth of your investments? So I think it's really important there. And yeah, like you said, if you're in the accumulation phase, you should, it's easier said than done, but you should embrace the idea that if you have a regular, systematic approach where you're buying in weekly, you're getting more shares for how much you're purchasing, and you're building up your stockpile of owning that world stock market or whatever you're owning. And, the whole reason you're compensated in the stock market is because there is short-term risk. And if there wasn't short-term risk, then people would buy up these assets more, the demand would increase, the price would increase, and your expected returns would decrease. So you have to become comfortable with these short-term declines, because that's ultimately why you're rewarded in the long run.
Yep, absolutely. And I think it's another thing to consider that we often forget is looking back, right? There's different numbers that are quoted, but the US stock market historically returns, you hear different numbers, right? 8, 9, 10, 11%.
Right.
Let's just say 9 or 10%. And that sounds nice and steady, right? But it's not interest. It's not an interest payment. It's not a dividend payment.
Yeah. Those earned through volatility.
Exactly. And I don't, but even now when we see crazy returns, right? Historically, real estate's up 20% every week, and crypto and this and that. Sometimes that 9-10% sounds like boring. Anyway, where I'm going with this is, I don't have the stat, but I believe if you look back, say 100 years, the number of years where the return in that year was around 9 or 10% was very, very few, right? So that means most of the years, the returns are not 9 or 10%. It might be 25, it might be 18, it might be negative 25, right? And so again, looking back, we feel like it's smooth and steady, but really it's like really lumpy, right? It's really, almost spastic, where, it ends up working out historically and averages out. And so, we've had some great years, and we might have, this year could be a great year, right? It's starting out not so great, but it's all over the place historically. And so this, from a historical perspective, in some measures it is unique, right? They're all unique, right? Like there's that common saying, this time it's different, right? I'm selling everything because this time it's different. Well, they're all different. So you could argue that with all of them. But we get jumps all the time, every year, and we forget a lot of them, right? Even COVID, that's a very forgettable. Another one that's, I'd say 99% of people forget, maybe 100. December 2018. All right. There was a relatively quick, that was shortly after you and I started our firms. Yeah. That was relatively quick. But it was, a 20% drop. And again, now if you reference that, right, we basically skip over a lot of bear markets. We
Yeah.
talk about 08, 09, and then we talk about COVID, right? But really, there was a 2013. There was
March 2020, we talk about a pandemic too, but that's recent.
yeah. COVID, yeah, March 2020, and then we talk about 08, 09. But we forget about some lumps along the way.
Yeah, we gloss over it. We gloss over all of the 10% corrections, right? Any given year, you should anticipate a 10% correction, even when the stock market's up. So there's going to be intra-year volatility. And yeah, this is just a normal part of investing. I guess, some questions I've received from clients are like, do we change our investment strategy, because of this bear market environment? What are some things that we can do? And I have some thoughts there, but is there anything that you would say to add to that? Like, as far as if somebody asks you that, what would you say?
Yeah, absolutely. I think, generally, right, it doesn't make sense, right? There's different risks you have with investing, right? That there's plenty of research on. And then you can add additional risk by bringing in market timing, right? We're going to try to time the market now. Okay, now there's timing risk, right? So, I mean, there's plenty of data on this, right? Historically, it doesn't make sense. But I guess for anyone that does change their investment, methodology now and does some drastic thing, my guidance would be have a plan for being wrong, which I think a lot of people don't do, right? It's like, I'm going to sell everything because the market's going to crash over the next year. Okay, right? If you really, it's your money, right? If you really, really, really want to do it, you really, really believe it. Again, we work on behalf of the client, right? So if they are really want to do it, then they can do it, right? They have the power to. But I think where people miss is they don't have a plan for being wrong. When do you get back in, right? Or when do you say, oops, I was wrong? Like, say you sell today, I saw this during COVID, right? It looked like the world was going to end. And then the prices start going up and up and up. And are you waiting for a price point? Or are you waiting for an announcement? Are you waiting for a vaccine rollout, right? Or at what point do you change course and say, oops, I was wrong? And I think that's very, very challenging. Again, similar, even if you're right, you sell everything today, it keeps going down, it keeps going down. And at what point do you get back in? But I think usually it's the first one. Have a plan for being wrong, because there's plenty of folks that got out for various reasons, right? Maybe someone was getting elected that they didn't like, and then things started going in a good direction for everyone else and not a good direction for the seller, and then you kind of get frozen. Your feet are in concrete. And it's hard to get back in. I've definitely seen it. So that's kind of general thoughts.
Yep. No, that makes a lot of sense to me.
What about you? I know you've gotten a couple questions about changing course or what.
Yeah. So I think it depends, right, on like what kind of client they are. Like, right, if they're in that accumulation phase, right, they're in their 30s and they're high earners, and like, yes, you always want to have that cash reserve, right? So that if in the event you lose your job, that's the most important thing in that phase. But if you feel like you have good job security and you have that, 3, 6, whatever you need for buffer to make you feel comfortable, there's really not much you should be changing other than embracing the fact that, you should have some kind of system in place where you're buying in weekly, through your 401k, in a taxable account. You should feel good that you are buying in at lower and lower intervals, because ultimately you will be rewarded for that. And, outside of that, there's really not much you can do other than maybe there's some rebalancing opportunity. Although if you're invested aggressively and have 90% plus of your assets in stocks, probably going to be hard to rebalance. But, there are tax loss harvesting opportunities, which we've debated before as far as like the real value there. But I still think there's value to taking losses and staying invested and being able to use those losses once the market does rebound. If you need money, you can take your money basically tax-free. So I think there's opportunities there. But that's the accumulator. I really think you should be invested appropriately to start. You should have already, hopefully you had been working with a financial planner or something like that, and you'd already kind of identified what your cash flow needs are and your cash reserve. And so if you've already done those things, then you probably feel pretty confident, like you've been educated on, I always talk to clients about again, understanding volatility and understanding like this is why you're compensated. There are always going to be periods of drawdowns, things like that, for anybody. And so that person, really nothing changes there. You know, if you are in that financial independence before retirement, you're using your investment assets, and I actually do have a few people I'm working with on that. We have a very large cash buffer, and we have, I start with 18 months of cash reserve. And the reason is because historically, average bear market is 1.7 years, 1.8. So 18 months of cash reserve. Now, it's not to say that bear market can't last longer than that. Historically, just looking back at some of the data, because I have it pulled up, most are beneath that 1.7, but there are a few, 07, 4 years, .com, 4.6, 70s, looks like there was a 5.8. So it's not that it can't happen. We'd obviously have to make more adjustments if that happened, but having 5 years of cash on hand is just not realistic for people. And I also just think bear markets and markets are moving quicker. Like I think that we're going to see sharp declines more often, but we're going to see rebounds quicker as well. I think markets are just moving faster because information is being changed faster. But again, if you have that cash buffer, then, you know, you should be fine. The only changes is that, you know, hopefully you're allocated appropriately beforehand based on what your needs are. And then you just reduce the withdrawal rate, what you're taking from the portfolio as the markets go down. So if you have a range of a 3 to 6% withdrawal rate, you know, you're staying within that range, but you're also reducing based on the updated account values, right? And then you're using your cash buffer to hopefully weather that storm. And then the same with retirees, like hopefully you have some fixed income sources between Social Security and maybe a pension or rental income, something like that. Like hopefully you have your bare necessities covered and you're giving your portfolio time to rebound. So, I mean, that's how I would handle it. So I guess overall, there's not a lot of changes because we've put a plan in place beforehand. Obviously, if you're in this now and you've never done anything and you're all misallocated, I would still focus on, based on today, making those changes moving forward. Forget everything in the past and just focus on today.
Yep, no, totally agree. And you know, we have a number of clients in that situation you described, or retirees, and again, similar, right? We're talking about cash buffers. You know, having obviously a diversified portfolio. A lot of folks in retirement are, you know, have some Social Security, maybe their mortgage is paid off, right? So they have some protection in place. And then you know, they obviously have the equity risk, which you know, the good news maybe for a retiree is they've been through many bear markets, right? And they've seen this. And that brings up another point. I think it's I think it's always important for us as advisors to pay attention to, you know, when clients are a little uncomfortable, because, you know, we might have conversations when we're setting up a portfolio. You know, some folks do like risk tolerance questionnaires. And I think a lot of that's all well and good, but I believe the data shows, right, that you know, us as humans, right, the way our brains work, we are ill-equipped to properly answer those correctly, right? Risk tolerance questionnaires, right? You know, if I told you, hey, flight turbulence happens, you know, 1% or 10% of flights, so it's going to happen, you know, dozens of times in your lifetime. How are you going to feel if you have flight turbulence? And you might say, oh yeah, totally fine, no big deal, right? But then it happens, and you start tightening up a little bit, you start grabbing your seat. And so where I'm going is sometimes clients will show a little bit of not too much pleasure they're having when there's a little bit of turbulence, right? So even these like 2, 3, 5, you know, 10% drops, which, you know, as you mentioned, on average, you know, there's I think 13, 14% drop on average, right, every year, right? And so when folks are having those uneasy feelings about during those times, I always try to like, hey, let's kind of dig in there. Let's dive deeper, and let's, you know, maybe it makes sense to de-risk a little bit, right? I'd rather have a client, if they're going to make a change, de-risk during a 3, 5, 6, 8%, you know, a little bit of a bumpy road, right? Versus now. We're 20, like you mentioned, VTI, broad market index, we're 20+% down now. Now it's kind of not the time, right? If the car's moving and it's going 5 miles an hour and you want to jump out, okay, that's not ideal, but hey, you could do it. Now we're going kind of 30 miles an hour. Usually it's best to kind of stay in your seat and keep the seatbelt on.
Yeah, no, for sure. It's better. All or nothing moves are almost always the wrong thing to do. Because that really is timing the market, right? You're getting all in, you're getting all into cash, you're getting all into stocks. Like if you're going to make adjustments because you feel now, ideally you want to, like you said, you want to have these conversations before the drop. But if you need to reduce your stock exposure because you just can't handle it, then yeah, it's better than getting rid of all your stocks, right? So, and I guess on a somewhat similar note, and this is my last thought here, is the whole, buying the dip thing, right? Like as far as that's, become popular. And I just think it's really important when people say buy the dip that you separate what you're talking about, right? Because it's very different when you're talking about buying the dip with these broad indexes like this, the whole stock market versus an individual company. Because as we know, historically, like most companies that come into existence, over 50% don't survive because companies are constantly being created and destroyed. And so thinking that you're going to buy the dip on an individual stock, yes, if it does rebound, it could work out amazing. But there's not always that reversion like there is with the global stock market or stock markets in general. And it's a very dangerous thing to keep buying a stock that's dropping versus the index. So I just think it's important to separate those. And I'd love to hear your thoughts on that too.
Yeah, absolutely. I think I think with buying the dip, hey, it's always good to buy at lower prices, right? But a lot of times I think one thing that gets in the way of folks that are trying to buy the dip is they're anchoring towards prior prices, right? The stock, it was at $100, now it's at 30. It's just got to get back. Good buy. It must be a good buy, right? It's like there's a reason it's at 30 and that 100, maybe it was appropriately priced, maybe not, right? A stock that dropped 70%, it can still drop 90% from there. Correct, and we've seen plenty of examples on that. And so again, going back to, I guess, a comment earlier, have a plan to be wrong, right? Say you're going to buy it, when it's dipping, well, it could dip a lot further, right? Are you going to dip? Are you going to buy again at that point? Are you going to double down at that point? Again, historically, buy on a regular basis. Sure, if there's times like this and you have some extra cash that's not allocated or what labeled for a particular goal, right? If you want to start increasing that, be a little more aggressive, sure, by all means. But I agree with what you said. Typically, major moves in either direction are not sound. And going back a little bit, you brought up those stats about bear markets, and I wanted to just highlight those since we were chatting about that prior to hitting record, and maybe we could put a link as well.
Yep.
So the average decline, right, from sort of peak to trough is around 11 months. So the decline, and then the average time it takes to recover, so kind of go back up and reach the prior peak. Like you mentioned, 1.7 years, or that's about 21 months. So the average time from sort of peak to reaching that point is about 2.5 years, 31 months. And like you said, obviously that's an average, and there are it could be longer, it could be quicker. We never know, but
I personally, again, it could always be longer. I would bank on it being shorter, but that's why you want to plan on being wrong, right? So give yourself that buffer. But yeah, that's a good point. That's a good point there. And real quick, I want to add one thing to your buying the dip comment. It's one thing where you're like dollar cost averaging and you're allocating your cash flow, and then you're buying the dip because you're always buying in. But if you are buying the dip with cash that's just sitting there, by definition, you are market timing because you had cash sitting there. So I just think you want to I think it's good to buy the dip when it's like part of your natural strategy for dollar cost averaging. But if you're looking to buy the dip with money that's just sitting there, that's not allocated, I don't love that, because by nature, that is kind of like market timing, and that just not a great way to invest.
Yeah, absolutely. I think if you want to, if folks want to nibble, right? Like you mentioned, if someone maybe has 18 months of cash buffer, um, and if they really wanted to go for it, or if they wanted to use a month or two, right? Again, you're right. It is market timing, but we're all irrational, right? And
Yeah.
we all make these emotional decisions. And so I think I'd rather someone nibble than, like you mentioned, kind of go all in. You
Yeah.
know, don't sell the house to buy the dip, right? Don't do that. Right. If you want to, you know, uh, make some, I'll tell clients, right? I don't care if you go to Las Vegas. I just care if you sit at like the $10,000 per hand table, right? If you go there and you're at the $5 per hand table, right? Have fun, good luck. So, or some, if they have an outside trading account, right? Yeah, good luck, go for it, 2 thumbs up, keep it, you know, keep it within reason, right? You can definitely get aggressive and you can get dangerous. You can
Yep.
go big, you can some option, horror stories, right? But I agree. Maybe you're more disciplined than I am.
No, I mean, I don't know. I just, yeah, I'm all for rules. So rules-based investing. But yeah, so that's all I have. Is there anything you would like to end on?
I don't think so. I think we covered a lot and talking about different emotions and different strategies. And maybe one item we didn't touch on was employment, right? Employment market.
Yep.
It seemed like a month ago we have way more job openings, and unemployment rates really low. So super strong employment market, and a very decent time, right, for folks to kind of jump ship if they want to go somewhere else and make more money. But it seems like now, that still may still be the case, but now, fundraising is down a little bit. Layoffs seem like they're starting to, begin. So I think in times like this is based on no real data. I personally might be a little more hesitant to, jump ship and leave my
Mhm.
more cushy big tech job for a startup,
Mhm.
unless obviously the personal finance house was in order. I don't know if you have any thoughts on that.
No, it's a good point. I haven't put much thought into it, but I mean, yeah, we've experienced such a great environment for startups and like all these equity comp, getting, stock options in your company. And I think we want to avoid that recency bias of like, oh, it was a great idea to exercise these options to get the clock ticking on long-term cap gains. And it's like, that historically has not always been the case. Like there are times where you could waste a lot of money exercising options
Mhm.
or building equity in these companies that never materialize. And so, yeah, I think it's just, again, you should always like, focus on what the company does, and you have to believe in, if you're working for a startup, like you have to believe in their vision. But yeah, I mean, this economic environment probably isn't going to be as conducive as it was to having that potential windfall.
Yep. But no, good chatting as always. I always appreciate your perspectives.
Likewise.
We do a lot of the same stuff. We work with a lot of similar clients, but there's, we learn a lot,
Yeah, exactly.
from each other.
Agreed. Awesome. Well, looking forward to the next episode.
Alrighty, take care, TJ.
Take care.